And so, one of the first tax mistakes that I see a lot when it comes to business owners, realtors, real estate investors, is that you do not separate out your business and your personal finances. When you don't separate your business and personal finances, you cannot get a clear picture of what's taking place in your business, which means that you don't have a good understanding or you can't make good, smart decisions when it comes to your business. And also, when you mix your business and your personal finances, that's considered to be commingling funds. And the IRS literally hates when you commingle funds. That is a no no in the IRS eyes. But just furthermore, outside of with the IRS, when you commingle funds, it just does not give you a clear picture of your business, and it makes it harder in order for you to make smart business decisions. And it's also harder when it comes for tax time because you don't want to be taxed on something that is personal and not considered a business. And you also want to make sure that you're taking into account all of the deductions that you can for your business. But if everything is just intermingled, just kind of commingled together, it is really hard to have a clear picture of what has taken place. So I see that mistake, and it is not good when it comes to operating your business. And so another mistake that I do see is misclassifying transactions and activities when it comes to operating your business. So meaning that what I see often is that when someone has established a business and they may have contributed their personal funds to it and made some type of investment into it, or others may have invested into it, that they consider that to be income, and it may not necessarily be income, which means that they are overpaying on taxes when tax time comes, as well as with real estate investors. I see that with when it comes to owning rental properties, not knowing what's considered to be true rental income. So at the end of the day, possibly being taxed on information that is not considered to be taxable income. So a big mistake I see, make sure you're classifying your income correctly, make sure you're classifying your expenses correctly, because you want to make sure that you're getting credit for all the expenses that you have in your business as well. And so a third mistake that I see is that many do not report all of their or provide all of their tax information to their CPA. And so if you receive any tax forms, then that needs to be included on your tax filing. And so if you receive the tax form, that basically means that the IRS has already received a copy of it. And so they are going to be looking for that information on your tax filing. And so if you do not include any of those tax documents on your tax filing, you will get a letter from the IRS basically saying that, hey, we have this information that was reported to us, but we don't see it on your tax filing. So you need to revise your tax filing to either include the information, or the letter would say, we received this information, you didn't have it on your tax filing, we've already done the liberty of including it for you, and this is what the outcome is. So include all of the information. I do see one form in particular that is forgotten a lot to be provided to CPAs. In one, as a business owner, as an investor, many times you're paying for your own insurance out of pocket, and you may have the marketplace insurance. And so, since that is actually through a government funded program, you get a document at the end of the year, which is a 1095A form that is considered to be an official tax document that needs to be included in your tax filing. And there are so many people that don't realize that that needs to be included. And so it's not included. And when they submit their tax filing, it's one either rejected if it's done electronically, or if it's not rejected and it gets to the IRS maybe through mail, the IRS will send you a notice saying, hey, this information was not included on your tax filing and you need to include it. And so that's one of the biggest forms. So if you happen to receive a 1095A from the marketplace, make sure that you're providing it to your CPA and make sure that it is included on your tax filing. And the final tax mistake that I'm going to discuss is basically waiting to the last minute to provide your tax information to your CPA. That is not doing you any justice when you do that, because when you provide it at the last minute, you're putting your CPA in a situation so where they have to rush to do your tax filing. And of course, just by human nature, nothing personal against anyone, by human nature, when you are rushing doing things, there's you're susceptible to making mistakes and having errors. And so you don't want to have any mistakes on your tax filings. You don't want any errors that takes place. And so provide the information to your CPA early enough. Give them enough information, give them enough time to be able to go through everything thoroughly so they can report your information correctly and put you in the best position possible when it comes to filing your taxes. And so, yeah, those are the tax mistakes that I make that I see many taxpayers make. And so, if you avoid making those mistakes, I promise you that your CPA would absolutely love you for it.